Okay, good morning, everyone. So, yesterday, I hope you all had some good sleep. We had a very heavy session yesterday. Now, we will just spend maybe a little bit more time on completing with this chapter of international finance. And after that, we will go to the next chapter that is futures. All right. Can you please go through this question? Let's crack this question. I'll give you a minute's time. Please read and understand this question, after which we will do it together. All right, friends, let's write down the basic data together now. Working note 1. Basic data. All right, fine. So they have told that he has to pay how much money? $364,897. So dollar payable 364,897. All right. And the duration is told to be 6 months. Down they have given a table. We don't have to copy the table. Below this, they have given some details about currency options. Friends, options we will do it later on once I complete the chapter of options. Okay. So there are three choices they have given. One is forward, money market. Option we will do it later. All right. So let's start with forward cover. So I'll write down working note number 2. Amount payable in the forward market. Do one thing, I'll give you a minute. Can you write down the basic data in your books now? See, not required. All right. I hope you have all put up till here in your books. Let us now do it using the forward market. All right. So I'll write down over here point number A. Dollars payable $364,897. Now tell me whether it will be a bid rate or whether it will be an ask rate. I will draw the picture here. You first guess the answer and only then look at the board. This is the person, let's say it's A. This is the bank. Since he has to pay dollar, what will he do now? He will buy dollar. In return, he is going to sell sterling. Bank will buy sterling, sell dollar. Dollar bar sterling is the exchange rate. Am I right? Dollar is the commodity. What is the bank doing with dollar? Sorry, sterling is a commodity and bank is buying sterling. So what rate is applicable over here? Bid rate. Okay. So once we get that, I'll find out what is the 6 months forward bid rate. All right. The 6 months forward bid rate that is given in the question is 1.5455 dollar bar sterling. Okay. Therefore, sterling payable will be 364,897 divided by 1.5455. That will give us the answer as 2,36,102 sterling. Can you please write down till here in your books, friends? Once you're done writing, please let me know that you're done. All right. AJ is done. Let others also finish. Okay. Deepika is done. All right, friends. So you've got the answer under forward market. Now I'll write down the next working note. Amount payable under money market hedging. All right, friends, here do we have an asset or a receivable or a payable? We have a payable. So what will we have to do? We will have to create an asset. First, I'll draw a picture and explain to you. After which we will, put it in a proper step. The first country is UK and the second country is US. All right. So since I have a payable, here I'll create an asset. So I will deposit some dollars, which along with the deposit rate in US. How much is the deposit rate in US? 4.5 is for 1 year. So for 6 months, it will be 2.25 percentage. This should increase to 364,897. So the dollars to be deposited right now will be 356,867. All right. Okay. So once I get this number, in order to deposit this, I have to borrow some sterling in UK and convert this so that I should be getting, let's convert at some rate so that I should be getting $356,867. Am I right? So first question that I need to ask is, will it be a bid rate or will it be the ask rate? Look, first what I will do, I will borrow sterling. Then I will give the sterling to the bank and take dollar. Am I right? So when I'm selling sterling to the bank is buying sterling. So what rate is applicable over here? The bid rate. What is the spot bid rate? 1.5617 dollar bar sterling. So if I do a backward working, the amount that I need to borrow and then convert will be 356,867 divided by 1.5617. 228,512 sterling is what I need to borrow, and this I need to borrow at the UK borrowing rate, that is 7% for 1 year, 3.5% for 6 months. So this plus 3.5% will turn out to be 236,510. So friends, this will be the money that will be paid by A. Okay. Whereas along with interest, once it increases to this much, this will be transferred to the creditor or the supplier. Can you please write down till here in your books now, friends? Once you're done, please let me know that you're done. Okay, Dimple is done. Hi AJ, I think they are uploaded. I'll just cross check and get back to you. Yesterday it was handed over to them. Let me just cross check. Let me check it here itself. I think it's done. Just go to my website. Click on live. If you click over here, you'll get to know. 1 minute. The solutions. Already, it's not yet done. I will follow up, and by morning before 11 o'clock, I'll make sure that those materials also come over here. All right. And yesterday, some concerns were raised, right? That some words were not readable. I have changed them over here. Please go and cross check. If still you're facing issues, please let me know. Okay. All right, friends. Are you done with this now? Let them finish. I'll give you a minute more. All right, friends. Now let's write down this neatly. Okay. I'll write down point number A. Since A Limited has a payable, we should create an asset by depositing in dollar. Dollar to be deposited is $364,897 divided by 1.0225. That is 356,867. All right. Then, in order to deposit $356,867, we should first borrow how much? 228,512 at 3.5% and convert this at the spot bid rate of 1.5617 dollar bar sterling. Okay. The next point, 228,512 sterling plus 3.5% will be equal to 236,510. This will be paid by A. Can you please write down till here and finish it off, friends? Once you're done, please let me know that you're done. Okay. All right, friends. I hope you're all done with this also. So we are done with this question so far. Options will do it today once I complete the chapter of options. Okay. So now let's go to the next concept heading. Everyone write down the next concept heading. Nostro, vostro. Friends, I have given the entire logic of Nostro Vostro here. Full in writing I have given along with the logic of adjustments, and I have given a question answer also where I have given the question also and the answer also. So right now I'll focus on the logic. So once the logic is done, this one question you have to do it as homework, and then tomorrow if you have any doubts we will discuss it together. Alright. So let's focus on the logic of Nostro Vostro. Alright. Now everybody interact with me. Look at the board. Tell me, which is this country? India. Okay. Let us assume this is State Bank of India. And let us assume this is which country? USA. And let us say this is State Bank of USA. Alright. Now SBI fellow has made a deposit. Alright. Has made a deposit of, let us say, $1 lakh in the US bank. Alright. So when the US bank will give you a statement, alright, normally the statement will have a debit and it will have a credit. Am I right? Now tell me, this $1 lakh will come as a debit balance or a credit balance? It will come as a credit balance. Why will it come as a credit balance, friends? Mainly because credit over there would mean that US bank has to pay this money back to SBI bank. So credit means positive balance, debit means negative balance. Alright. Now practically, let us understand that we do bank reconciliation statement. Bankers definitely have to do bank reconciliation statement. So what happens is every day morning there will be one guy from the Indian bank, that is the SBI. He will be calling the US bank and asking one simple question. What is the balance of my account in your bank? US bank fellow will reply and tell the balance of your account in my bank is $1 lakh. Next day morning again the same question. What is the balance of my account in your bank? He will tell the balance of your account in my bank is $1 lakh. Third day again, your account, my bank, my account, your bank. Their life became miserable. So finally they decided that rather than telling all this my account, your account, my bank, let us use some shortcuts. So they said that if you are trying to ask my account balance in your bank, they will use the terminology called as Nostro. And if they want to say your account balance in my bank, they will now start using a terminology called as vostro. So friends, after this was created, it became very simple for both the bankers. SBI manager will just call and ask Nostro, and the other fellow will say vostro $1 lakh over. This is the purpose of creating Nostro and vostro. Can you please draw this picture in your books now? All right, friends, if you have put up till here, now I will tell you, when SBI puts money in US bank, there are mainly two types of accounts which are maintained by the US bank. One is called as the cash position and the other one is called as the exchange position. All right. Cash position will have two things. One is debit and the other one is credit. Whereas exchange position will have buy and the other one over here will be sell. All right. So now I'll tell you in a very simple language. Okay. I'll just maybe take a fresh page. Can you draw this first in your books? All right, friends. Now I'll go to a fresh page and I will just show you. I'll just put a heading called as particulars, cash position, okay, exchange position. Okay. I'll do one more thing here. I'll just mention in cash position, all real transactions only will come. Okay. Whereas in exchange position, both real transactions and imaginary means derivative, etc. Both transactions will happen in exchange position. Can you please update this also in your books? All right, friends, if you have put up till here in your books, I'll just show you a few examples. Okay. Now, if SBI is depositing $1 lakh, is that a real transaction or an imaginary transaction? It is a real transaction. All right. I'll put debit, credit, buy, and sell. All right. Now, I told you if the Indian bank is depositing $1 lakh in cash position, where will it come? Debit side or credit side? It will come on the credit side. All right. When I told you exchange position, both real as well as imaginary will come. So this is a real transaction. It will come in exchange also. Now, how did the Indian bank get $1 lakh? Indian bank would have given rupee and they would have bought dollars. So here it will come as what? Buy $1 lakh. Only after they buy this $1 lakh can they go and deposit this $1 lakh. Am I right? Suppose after this, the Indian bank is withdrawing $20,000. All right. Here, where will it come? It will come in debit. After withdrawing, what will the Indian bank do? Sell these dollars so that they can get rupee. So it will come as what position over here? It will come as a sell position. So friends, this is one very important thing that you need to understand. Credit transaction will always be linked with buy. And debit transaction will always be linked with what? Sell. Okay. And now let me give you one more thing. Suppose the Indian bank is buying $5,000 in a forward contract. Now tell me, forward contract is a real contract or imaginary contract? It is imaginary. So in cash position, nothing will happen. But here we will have a transaction called as $5,000. So if you put it this way, $1 lakh minus $20,000, the closing balance over here will be 80,000 credit. Whereas in the exchange position, 1 lakh bought, 5,000 bought, that is 1 lakh 5,000 minus this, we will call it as $85,000 overbought. Overbought means buy is more than sell. Can you write down this in your books now? Alright friends, have you all put up till here in your books? Once you're done, please chat and let me know that you are done. Okay. Shubham is done, let others also finish. Alright friends, so now you have a homework, that solution, that logic, everything I've given very transparently in my own writing style. So it will be very easy for you once you go through it. You will understand. If you have doubts, let me know. Tomorrow morning what we will do, we will again cross check the whole thing. Alright? Okay, so we are done, not tomorrow, Monday. So I hope you're all done with this. Then let's go to the next chapter, futures. In that you write down concept number 1, continuous compounding. Everyone please write down this, then I'll explain with in a fresh page. Alright friends, now I'll explain this to you. Suppose the amount what I am investing is 100 rupees. Okay. Let us say the rate of interest is 10%. And I am actually going by yearly compounding. Okay. So in this case, I'll just give a heading called as computation, and I will write down something called as future value. Okay. So here the formula will be 100 into 1 plus 10% whole raised to 1. I will get the future value as 110, and my effective rate will turn out to be 10% only. 100 becomes 110 means effectively it is 10%. Alright. Suppose the same 100, same rate is 10%, but instead of going by yearly, I am going by half yearly compounding. Now the formula will be 100 into 1 plus 5% whole raised to 2. I'll get the answer as 110.25. Effectively, my rate becomes how much now? It becomes 10.25%. Am I right? Suppose the same 100, I am doing it 10%, but I am doing it quarterly. Okay. The formula will be 100 into 1 plus 2.5% whole raised to 4. I'll get the answer as how much? 110.38, and my effective rate will turn out to be how much percentage? 10.38%. Now suppose I'm doing 100, 10%, and I'm doing it in daily basis. Then my formula will be 100 into 1 plus 10 divided by 365 whole raised to 365. Alright. The answer what you will get is 110.51. The only way you can find out this is, doing it in Excel. You can't do this normally. This is what we call it as continuous compounding. You write down, then I will show you in Excel how I am getting the same answer. Alright. Just write down till here in your books. Yes, yes, yes. So this should be after the bracket. You're right. Okay. All right, friends. I'll just show you in Excel how this actually comes. Uh, so this is 100. Now here I'll do, this should be equal to 0.10 divided by 365. Am I right? Okay. So it should be equal to 1 plus, sorry, 1 plus this will give us this answer. So I should be doing 100, wait, just come over here, 100 into whatever number I got over here, whole power 365. Am I right? Why is it coming like this? Just a minute, friends. I think there's some mistake in the formula that I have put. Wait. This is 100. This is 1 divided by 0.1 divided by 365. Correct, that's 10% divided by 365. This is 1 plus this rate. Yes, this is equal to, let me do it one more step. This will be, okay, this will be this raised to 365. So whatever answer I get, 100 into this, right? So I'll get the same answer as 110.51. All right. I hope you have got this answer. Yes, Ramani, I'm coming to your doubt of how to handle this in the examination. I was just trying to show you that numerically this is right. Now in exam, this is not how you can do it. So in exam, we have to use a formula. Okay. There are two types of continuous compounding. One is called as continuous compounding rate, and the other one is continuous compounding factor, right? Continuous compounding factor, or I call it as CCF, and the other one is continuous compounding rate, which is nothing but CCR. So here the formula, that shortcut formula which we have to learn is 1 plus R square divided by 2. That is 1 plus 10% plus 0.10 square divided by 2. If you do this, you will get the answer as 1.105. CCR is nothing but from CCF. All right, if I remove 1 and then if I multiply with 100, I will get the answer. So I'll get the answer as 10.50%. Can you write down this in your books now? Alright friends, have you all put up till here in your books now? Ruchi Jain, yes, this formula is, let's say, this continuous compounding factor. Some books call it as e raised to RT. I'm coming to that part. Alright. So you all can write it down. Continuous compounding factor is nothing but e raised to rt. Okay, now I will just explain to you with an example. Okay, so you can give a heading called as future value, okay, using continuous compounding. Friends, here we can use a formula. Future value is equal to spot value into e raised to rt, or this is what we call it as f0 is equal to s0 into e raised to rt. So the future value will be 100 into 1.105, that is equal to 110.5. Can you write down like this in your books now? All right, friends, have you put up till here in your books? Okay. Next one we can learn. Write down the next heading in your books. Present value using continuous compounding. All right, friends, we have already learned that present value factor is nothing but 1 divided by future value. Am I right? Let's say for example 0.909 is nothing but 1 divided by 1.1. Similarly, present value using continuous compounding is called as e raised to minus rt. Alright. So e raised to minus rt will be nothing but 1 divided by e raised to rt. Can you write down till here in your books now? Alright friends, if you have put up till here in your books, then I will just explain to you. Earlier I told you future value of future value of 100 at 10% continuous compounding is 110.51. So in the same manner, can I say present value of 110.51 at 10% continuous compounding will be nothing but 100. So the formula for this will be S0 will be equal to F0 into e raised to minus RT. Alright. So 110.51 into 1 divided by 1.1051. Alright. You will get the answer as how much? 100. Can you write down till here also in your books now? Friends, there is a little bit of current fluctuation over here. I hope the video is still live. Alright friends, I hope you have all put up till here in your books now. Alright, so we have learned what is present value using continuous compounding, what is future value also. So just let me repeat the terminology. We learned e raised to rt. This is nothing but 1 plus r square divided by 2. Alright. This is what I call it as continuous compounding factor. E raised to rt is nothing but 1 divided by e raised to rt. Just write down this so that you have no confusion at all. Yeah, Dimple, I just unmuted that to check whether the video is coming live. I have muted it. Okay. All right, friends. Have you all put up till here in your books? Okay. So now we are done with this. Can we now write down the next concept heading? Theoretical future price. Everyone write down this heading in your books. Theoretical future price. Friends, yesterday we learnt a question where S0 was 44, F0 was 45, I hope you remember that. S1 was 44.5 and F1 was also 44.5. I hope you remember this. If you observe, spot price was 44, future price was 45. You know why? That is because a future contract is nothing but a contract entered today for a future date. So theoretically, the future price should be the future value of spot price at continuous compounded rates. This is why we say that F0, that is future price, is nothing but S0 into e raised to RT. Can you please write down till here in your books now? Do you have the IIFL app installed in your phones? If yes, I'll just show you a little bit of that part now. If not, then you can experiment it later on your own. Okay, I'll just share with you quickly. I myself have opened the IIFL app. I can't show you in the laptop because it's done on my phone. All right. I'll just show you. I clicked. I went to virtual portfolio, which is where you don't have to invest any money. Inside that there are stocks. There are derivatives. I will first click on stock. That is a real market. All right. Inside the real market, I will click on add, and I will take a company. Let us say I'll take any company coming with the, or I'll take Reliance, or I'll take Infosys. All right. Infosys Limited. That's the name of the company. The spot price of Infosys is 703. So I just took IIFL app. Okay. I went to virtual portfolio. Inside that I first took spot market. All right. They call the spot market as stock. That is where real stocks are dealt. I took Infosys, and right now the price of Infosys is turning out to be 703.95. Now I'll go back. I will go to futures, which they call it as derivatives. All right. So I'm going to take futures now, which is coming under the heading of derivatives. Once I click on derivatives, I will click on add. Inside this, I will take FUTSTK. This is nothing but future stock. That is the meaning of FUTSTK. Once I take this, I will search for the company called as Infosys Limited. Okay. If you take Infosys Limited, they are giving some details like, expiry date. Now I told you futures are imaginary. There is an expiry date. The latest date is 25/6 2020. I'll take that expiry date. They are dealing in contract size, which they call it as lot. They're dealing in lot of 1200. That is the minimum lot that they're dealing in. And right now, the future price of Infosys is 702. Friends, here the spot price is 703, the future price is 702. What does that mean? Is the markets going up or is the markets falling down? The markets are falling down. If the market was going up, the Infosys futures must have been 704, etc. This is an indication that if you are already there in the stock market purchasing purchasing Infosys stock, you should sell it because very soon the price is going to fall down, because of which the future price has come down. All right. So here, when I did this 44 and 45, the assumption is that market is going up. Hence, today if it is 44, future it will be 45. I hope you are clear with what I just now said as far as the IIFL app is concerned. You can go and check this up yourself later on. It will be much more easier for you to understand futures more practically. Everybody clear with this? Okay. Let me now go to the next one. We have learned the concept of theoretical future price also. Am I right? Okay. Now write down the next concept heading. Hedging using futures. There are two parts to it. We can hedge using the same security or we can hedge using index. Hedging using the same security is easy. This won't come in the exam. This is interesting. I won't call it tough. This is interesting. And this normally comes in the exams. Can you please draw this chart in your books now? All right, friends, have you all put up till here also in your books now? Okay. George, I will do that. Candlestick charts, is it? Okay, we'll do that. But right now, let's focus on whatever is relevant from the exam point of view. I will be uploading many more videos on my website. In fact, the whole live trading I will be putting on my website very soon. So just subscribe to it or subscribe to my Telegram channel. Subscribe anywhere. One place you subscribe is enough because once I'll be sharing it everywhere. All right. Now let's do hedging using the same security. We were talking about Infosys. I told you there are two markets. One is the spot market and the other one is a futures market. Futures market is a derivative. It is more like an imaginary market. All right. Suppose I have bought Infosys shares for a price of 100 rupees. For creating a perfect hedge, what I should do here is I should sell Infosys for a price of 100 rupees only. Why I do like this is because if the spot falls down, future also falls down. If the spot goes up, future also goes up, because future is nothing but a mirror image of the spot. So suppose tomorrow this is falling by 10%. Here the price will become 90 and my loss will be 10. But Infi will also fall by how much percentage? 10. This will come down to 90, at which point I have to buy, and my gain over here will turn out to be how much? 10. So my net gain or loss will turn out to be how much, friends? 0. Can you write down this in your books, friends? Rangesh Badri, regarding Z value, yes, I have a video in my website. You can go to the chapter of derivatives, Black-Scholes model. I believe there's a separate video called logic of normal distribution curve. If you don't find it there, let me know. I will check and get back to you. It should be there. 1 minute. I'll just check it now itself. Strategic financial management. Hedging using futures. It is coming over here. Just try this Black-Scholes model. Inside this, I'll be explaining the logic first, and then only I'll be going and cracking the remaining part. All right. So you can just, Rangesh, you can just click on the Black-Scholes video in my website, and you will be getting the Z value logic also. Okay. Now, let's get back over here now. Done. So everybody is done till here. So from here, what I learn is that, friends, we don't use the word buy and sell. We use the word long and short. Long means buy, short means sell. So if you are long on stock, we should go short on futures. Secondly, if you are short on stock, we should go long on futures. Can you please write down this in your books now? If you're engaged, we're doing a question on Black-Scholes. I'll show you how to find out the Z value. Alright. You're talking about the chapter called risk management. The same logic applies to Black-Scholes also. Alright friends, now we'll write down the next concept heading. Hedging using index. Alright, friends, all the stock will not be there in futures. Infosys is there in the spot. Infosys futures is also there. But every security will not be there in futures. Alright, so let us say there is a security called as X Limited. This is there only in the spot market. This security is not there in futures. Now here I have bought this security for 100 rupees. If there was X Limited futures available, I will sell X Limited futures. But if X Limited futures is not available, I will go and I will sell Nifty futures. Okay. Now when I am selling Nifty futures, I should be careful of one more thing, which is called as beta. Let us assume the beta of X Limited is 2, which means for every 1% change in the market, X Limited changes by 2. Now, here I am buying 100. If I sell for 100 Nifty, that will not help. I will tell you why. Suppose this falls by 10%. This will fall down to 90 and my loss will be how much? 10 will be my loss over here. Now this security has a beta of 2. This means for every 1% fall in the market, this falls by 2. Nifty future is market. That means that for market will fall only by how much percentage? 5%. So I will have to buy back at what price? 95. My gain will be only 5. This gain is not enough. I should be getting a gain of 10. Only then my gain or loss will become 0 and I will be getting a perfect hedging. So instead of selling for 100, I should sell for 200. If I sell for 200, 5% fall will be 190 and my gain will be 10 over here. This against this loss of 10, my net gain or loss will be 0. How I got this 200, I'll tell you in the next page. Can you please write down till here in your books now? Alright friends, if you have put up till here in your books, I will now explain to you how I got this 200. Friends, the formula value to hedge in index futures is S0 into beta into percentage of hedging required. Here it is 100%. Alright. So what I did was 100 rupees was this value in the spot market. Beta was 2. I wanted 100% hedging. Hence I got the answer as how much? 200. If I wanted 50% hedging, I will do it only for 100. Can you write down till here in your books now? Ramani, I'll explain how 5% came. Beta is 2. Beta is 2 means for every 1% change in the market, security changes by 2. So if the security is falling by 10 percentage with a beta of 2 means market will fall only by how much? 5. That is why the security has fallen by how much? 10. Alright friends. So this was formula 1. We can find out the same answer using formula 2 also. Friends, when I sell with 200, can I say I am getting 100% hedging? 100% hedging is nothing but this means that there is no risk involved. No risk involved means I am indirectly shifting the beta from 2 to how much? 0. So 100% hedging means my beta becomes 0. The same answer I can find out using one more methodology where it can go like this. What is my current beta? Current beta is 2. Okay. What is my desired beta? Desired beta is 0. What is the reduction that is happening in the beta? 2. What is the value in the spot market? 100. Okay. So value of Nifty future to sell will be 200. Can you write down this also in your books now? Alright friends, have you all put up till here in your books? Okay. Fine friends, we are done with this part also. So exam point of view friends, if they are asking you, I want a 70% hedging, you can use formula 1. If they ask you, I want to reduce the beta to 0.6, you can use formula 2. Everybody is clear with this now? Shall we start cracking some problems on this part now? Okay. Everyone now let's take the handout of futures. This is a very good question. Can you please read through this question and understand this question? After which we will do this together. Alright friends, let's do it together now. First thing friends, there is no basic data required because all the data is available either in table format or in bullet point format, which is a requirement. Now they have given the security, they have given the price, they have given the number of share, and they have given the beta. From this price and number of share, can I find out the total market value? Once I get the total market value, can I also find out the weights? Once I get the weight, I multiply with beta. Can I not find out my overall beta? Friends, there is a lot of calculation involved. I will do in Excel. You do using calculator. All right. I'll take a fresh page. I'll just increase the size so that all of you can view it clearly. Okay. So what I'll do is after this, the next column heading will be market value. Okay, the market value will be this into the number of shares. Am I right? So I'll get the total as 188,54,860. From this I can find out the weights. The weights would be 9% for the first one. Okay. The sum total of this should be 1. Yes, that's 100%. Once I get this, I can find out beta into weight. Right? That will be this into this. And I'll get the answer as 0.85. You can round off to 2 decimals. The whole thing. Alright friends, can you write down this in your books now? Friends, once you're done, let me know that you're done. Okay. All right, friends. Ramani is done, Pavan Dubey is done, Chitra is done, others are still doing. Let them finish. Okay. So I believe everybody is done now. We have got the overall beta as how much? 0.85. Let us go then read the first requirement. Friends, first requirement by itself is beta of the portfolio. Have you already got the answer for this one? Now let's read the second requirement. The theoretical value of Nifty future for February 28 if the current value is 5,900. I'll write down working note number 2. Theoretical value of Nifty futures. Friends, I already taught you the formula. F0 is equal to S0 into e raised to RT. Am I right? Okay, so here this is 5,900 into e raised to R means rate, T means time. What is the rate of interest that is told over here? 10.5%. 10.5% into time they have told for February 28. So January 31 days, February 28 days, total will be how many days? 59 days. This into 59 divided by 365. Okay. So let's first find out e raised to RT. That is very crucial. So what is 10.5 into 59 by 365 would be 1.697 percentage. So e raised to RT would be will be 1.01697 plus 0.01697 square divided by 2. Am I right? It will be 1.01697 . So I'll get the answer as 1.017. All right. Therefore, the answer will be 5,900 into 1.017. I will get the answer as 6,000. Can you write down till here in your books now? Rangesh, if you take 2 by 12, your answer will slightly vary. Futures is based on actual number of days. So better we take it based on actual number of days only. Alright friends, everybody got the answer as 6,000 now? Okay. Now the next requirement. The number of contracts of Nifty an investor need to sell to get a full hedge until February. Assume it is dealt in multiples of 200 and the futures are trading at their fair value. Friends, they have given the multiple 200. So first let's find out the contract size. The next heading will be contract size. Value of one Nifty future is turning out to be 6,000. Okay. They are dealing in multiples of how many? 200. Okay. So from this, can you tell me what is the contract size that you get over here? I'll get the answer as 12 lakh. Can you write down this in your books first? Yeah, Manasi, which one you want me to explain again? The previous working note? Alright, I'll explain that part again. See, futures is nothing but S0 into e raised to RT. So the future spot in the real market, Nifty is having a value of 5,900. So Nifty future will have a little higher value because futures are always the future value of the spot value. 10.5% is the expectation for 1 year. So for 59 days, it will be 1.697 percentage. So when I did e raised to RT, I get the answer as 6,000. Is that your doubt, or if you have any other doubt, can you please elaborate and ask me so I can clarify that also for you? All right, friends, I hope you have written down till here in your books. Now they are asking for a full hedge. So I'll write down the next working note heading. Action to be taken for a full hedge. Okay. So for a full hedge, the action to be taken will be, I have already taught you, S0 into beta into 100 percentage. How much is S0? Most of you will tell S0 is 5,900. Friends, this is wrong. Are we hedging Nifty spot or are we hedging the spot portfolio? We are hedging the spot portfolio for which we already got the answer over here as how much? 188 lakh. This is my spot value which I am trying to hedge. People get very much confused over here. They by mistake take 5,900 because in the previous working note we took S0 as 5,900. Here it is going to be 188.54 lakhs into beta is of this portfolio into 100 percentage. Okay. So the answer what I will get will be 188.54 into 0.85, that is 160.259 lakhs divided by 12 lakhs to give us the number of contracts. So I'll get the answer as 160.259 divided by 12 lakhs. I'll get the answer as 13.35 contracts. Can you write down till here in your books now? Alright friends, have you all put up till here in your books? Now let me tell you one thing practically. Practically, can I enter into 13.35 contracts? No. So you can give a note below that. Practically, it is not possible to enter into 13.35. We can either enter into 13 or we can enter into 14 contracts. Can you write down like that in your books now? Alright friends, have you all put up till here in your books now? Okay. Contract size in this case is for rupees because value of one Nifty future is 6,000 rupees, multiples dealt in 200. So you can imagine that box. Inside that box there are 200 Nifties, each Nifty having a value of 6,000 rupees. Alright? Okay. Now, I'll now go and read the next part of the question. Show proof that in case of perfect hedge, there is no loss even if the market is falling by how much percentage? 10 percentage. So what I'll do is I'll show you. I'll draw a table like this. Spot. Here it is. Future. In spot, what am I done? I have long for a value of 188.54 lakhs. Am I right? Whereas in futures, what am I doing? I'm going short for a value of, what was the value friends? 160.25 lakhs. Now they are saying market is going to fall by 10 percentage. Friends, this is not futures, this is Nifty futures. So if Nifty spot falls by 10 percentage, Nifty's future will also fall by how much percentage? 10 percentage. Whereas this spot security has a beta of 0.85, which means for every 1% change in the market, this will change by 0.85. Hence, if the market falls by 10 percentage, this thing will fall by how much percentage now? 8.5 percentage. All right. So what is the revised value that I will get as far as the Nifty is concerned? 160.259 minus 10 percentage will be 144.233. So here I will cancel short, other one is long. So I will make a gain over here of 16.025 lakhs. Okay. Whereas in the spot market, the revised value, if it's falling by 8.5%, will be 188.54 minus 8.5, that is 172.51 lakhs. All right. So if this is the case, I'll make a loss over here. What is the loss I'll make over here now? I'll make a loss of 16.03 lakhs. Net gain or loss will be 0. Hence proven that whichever way the market moves, I will not make any gain or loss. Hence I am having a perfect hedging. Can you write down till here in your books now? Once you're done, please let me know that you are done. Okay, I'll go a bit slow here because these are complex topics. Your brain might not absorb it immediately. All right, let others also finish. Okay. All right, friends. So I believe now everyone is done. So we are done with this part also. Let us go and read the next part of the question. Number of future contracts the investor should trade if he desires to reduce the beta to 0.6. Friends, now they are asking for a revised beta. So we have to go by formula number 2. The formula number 2 will go like this. I'll write down Nifty futures to sell to get 0.6 as beta. Okay. I'll go by the earlier format that I gave you. Current beta is 0.85. The desired beta is how much? 0.6. What is the reduction that will be happening on the beta? It will be 0.25. What is the value in the spot market? 188.5 lakhs. Am I right? So S0 into reduction will be 188.5 into 0.25. I'll get the answer as 47.125 lakhs. Therefore, contracts to be sold will be 47.125 divided by 12 lakh contracts. So we'll get the answer as 3.92 contracts. By doing so, my beta will come down to how much? 0.6. Can you write down till here in your books now, friends? Alright friends, have you all put up till here in your books now? Fine. In that case, we are done with this question also. Shall we now go to the next part of the question? Okay. How can he bring down the beta to 0.6 by bringing in risk-free securities? I'll write down the next working note heading. Reduction of beta to 0.6 by introducing RF. Friends, this one is simple. I'll draw a table like this now. Particulars. So we already have a portfolio, okay, and now we are going to introduce RF. Beta of the portfolio is 0.85. RF has the beta of 0. Let me give the weights as X and 1 minus X. Now I can do beta into weight. Do I get the answer as 0.5x? 0. With this, my overall beta should be 0.6. Therefore, 0.6 is equal to 0.85x. Therefore, x is equal to 70.58%. This means in total, if my value is 188.5 lakhs, out of this 70.58% I should retain in the portfolio, and the balance 29.41% I should sell and I should invest in RF. So how much is 188.5 into 70.58%? 133 lakhs will come over here into 29.41%, that is 55.43. Can you please write down this in your books now? Alright friends, have you all put up till here in your books now? Okay, let others also complete, let me not rush. Alright friends, so if you're done with this part also, with this we are done with this whole question. And this one question is a beautiful question friends. This question covers 90% of the conceptual part of this chapter of futures. We did overall beta, theoretical future price, 100% hedging, we did proof, we did how to reduce the beta. Everything is done in this one question. I hope you are clear with this one part of the question friends. So we are done with this chapter of futures. Can we now go to the next chapter? Everyone write down the next chapter heading, options. Here there are mainly two options that we are going to learn. One is called as a call option and the other one is called as a put option. Can you draw this chart in your book? So I will explain to you this one by one. George, I just saw your doubt now. See, there's a question where they're saying that shares is 85 lakh, cash is 15 lakh, beta is 1.6. After 3 months, the price, I'll just give you the overview of this answer right away now. So you're talking about share value is how much you told? 85 lakh. Okay. Cash is how much you told? 15 lakhs. Am I right? And they have told that beta is 1.6. There is a confusion which the institute has also not clarified. Beta can be the beta of share alone, or it can be the overall beta. For time being, I'm assuming beta 1.6 is the beta of shares alone. Cash, the beta will be 0. Your weight will turn out to be 85% over here, 15% over here. Once you do beta into weight, you can find out the overall beta. Everybody clear with this one part? Now, they have told after 3 months, the price of share is dropping down to how much? 3.2. Find the beta after 3 months if the trader is long on 100 lakhs. Now here another doubt what I'm getting is 100 lakh trader is long means is it both share and cash? This is 100 lakhs. Am I right? Or is it 100 lakh of shares alone? For time being, I'm assuming it is 85 lakhs of share and 15 lakhs of cash. Now, revised. I'll give a heading called as revised. Okay. So here it will be 85 lakh minus how much percentage? 3.2 percentage. Am I right? So what is 85 lakh minus 3.2 percentage? You get the value as 82.28 as the share. Cash beta being 0 will remain the same at 15 lakhs. So your new total value will be 97.28. From this you can find out the separate weights. We already know the beta is 0.6 and here is 0. From this you can again find out the overall beta. Am I right? Can you please work out based on this guidelines on your own later on? And if you still get doubt, please WhatsApp me. I will definitely clarify your doubt. Okay. This is conceptually the same thing what we did right now. You can note down this number if you have missed out to note it down earlier. Just WhatsApp here. I will get back to you later. All right. Okay. Now let's go to this chapter called as options. I told you there are two types of options. One is call option and the other one is put option. So I will write down below this concept number 1, call option. Okay. Now interact with me. I'll give you a very simple example to explain this part. For this example, let us assume that we'll take one person from this whole list. I will take AJ. All right. Let us say AJ is a very, very selfish person. Okay. What AJ is doing is that today evening, let us say there is a concert happening. Okay. And this concert is happening in one of the famous halls. And in this concert, AJ's favorite person is coming and singing over there. Who is AJ's favorite singer? Let us assume it is Arijit Singh. Okay. So Arijit Singh is going to come and is going to sing. And the concert is starting, let us say, in the afternoon at exactly 2 p.m. Unfortunately, Tarun Jagdish is also taking class till exactly 2 p.m. So AJ cannot directly go to the concert. What AJ will do is that somehow AJ will know the owner of the hall where the concert is happening. I'll call this guy as Mr. Owner. So what AJ will do is AJ will speak to the owner and tell him, look, I have a class till 2 o'clock. I will reach there by 2:30. But can you please arrange a ticket for me so that once I come there in the crowd, I should not miss out a ticket. So now this owner will write a letter to AJ and the letter will go like this. AJ has a right to buy one ticket at, let us say the ticket price is 10,000 rupees. At a price of 10,000 rupees, and the owner will sign the letter and he will hand over this letter to AJ. Now in the afternoon, after the class gets over, when AJ is going for attending this concert, what AJ will do is at that point of time, there can be two situations. Situation number 1, due to high demand, the price of the ticket from 10,000 goes up to 20,000. At that time, what will selfish AJ do? AJ has got the letter from the owner. The letter says that, look, I can buy the ticket at what price? 10,000. AJ will push everybody, move, move. He will go to the ticket counter and he will say, see, I have a letter from the owner. You have to give me a ticket at what price? 10,000. So AJ will give the letter and buy the ticket by paying only how much rupees now? 10,000 rupees only. So even though the price went up to 20,000, AJ ended up paying only how much money over there, friends? 10,000 rupees. Now there can be a situation too. AJ is running to the concert hall where the program is going to happen. The moment AJ reaches there, he comes to know that the concert in which Arijit was supposed to sing, now Arijit is not coming because he's got some throat infection, and in place of Arijit, Dinchak Puja is going to come and sing. The moment this news spread across, suddenly the entire hall became empty. Now only AJ is standing there with a letter, and there is a ticket counter fellow standing there with great tension. The price of the ticket, which was 10,000, suddenly fell down and it crashed down to hardly 500 rupees. Now tell me, what will AJ do? Will AJ go and show the letter and tell, see, owner has given me the letter and buy the ticket at 10,000? No. What AJ will do now is, AJ will just tear the letter simply and go up buy a ticket by paying only how much rupees? 500 rupees, assuming AJ is a fan of Dinchak Puja. So friends, what is the moral of the story? When the price of the ticket goes up, AJ pays only 10,000. When the price of the ticket falls down, AJ pays only the lower price. This kind of an option where AJ has got a right to buy is what we call it as a call option. Can you write down this in your books now? Alright friends. Can you write down this also in your books now? Alright friends, have you all put up till here also in your books? Fine. So friends, call option is basically in a very simple language the right to buy. In a call option, there are two parties. One is called as a call buyer and the other one is called as a call writer. Alright. In my example, AJ is the call buyer, whereas the owner of the hall is what I call it as a call writer. The definition of a call buyer and a call writer is very, very important. The definition of call buyer is a person who buys the letter. I'll use the word letter because that's easy to understand, so that he can buy the share. All right. So here AJ was a person who bought the letter from the owner so that he can buy the share. This is the definition of a call buyer. Call writer, the definition is little different. This is where people get confused. So once we by heart the definition, the whole question will become easy. This is a person who sells the letter. Why does he sell the letter? so that you will now tell me so that he can sell the share. That is wrong. That is where people get confused. The called writer always thinks only from the buyer's point of view. Buyer is the god. Buyer says, I want to buy at 10,000. Owner will say, yes, sir. Buyer says, I want to buy at 500. Owner will say, yes, sir. Whatever the buyer says, owner will only say, yes, sir. So owner always thinks from whose point of view? Buyer's point of view. So that AJ can buy the share or buy the ticket. In my example, it was ticket, but exam point of view, it will be share. So always you have to understand the owner dances to the tunes of the buyer. Whatever the buyer will say, the writer will say, yes, sir. Can you write down this definition in your books now? Prabhakar, you have a good doubt. You're asking that in future sum, can I assume that 188.5 lakh is 70 percentage? So you will do 188 lakh divided by 70 percentage. You will get the 100%. So you can take that and the balancing figure you can tell as cash. Technically, that is right. Practically, that is wrong, because when you do like that, you are assuming that the person who is investing is the son of Bill Gates. He has got all the money in the world. Okay. So today, suddenly I decide that 70%. So just, jadoo, and then money will come in his hands. Friends, we are all short of money. So if he had more money, he would have put it somewhere else. Am I right? So 188 should be 100%, from which I should sell, make some money and put it in cash. Only then the beta will come down. Practically, that is why I didn't do the other way around. Okay. Alright friends, have you put up till here in your books? I want all of you to by heart this definition with me by feeling this definition. We will use some hand movements now. I hope you are free to use your hands. So for call buyer, the definition will be a person who buy, will show the buy like this and sell will be like this. So the definition is a person who buys the letter so that he can buy the share. Everyone repeat. A person who buys the letter so that he can buy the share. A person who buys the letter so that he can buy the share. A person who buys the letter so that he can buy the share. A person who buys the letter so that he can buy the share. Now tell me what will be the definition of call writer? A person who sells the letter so that AJ can buy the share. A person who sells the letter so that AJ can buy the share. A person who sells the letter so that AJ can buy the share. A person who sells the letter so that AJ can buy the share. A person who sells the letter so that AJ can buy the share. I hope you are thorough with this. I hope you have done some exercise also along with me and you have understood the definition thoroughly. If the base is clear, this chapter is very, very easy. All right. Now I'll go to the next one, which is concept number 2, put option. Okay. A put option is a right to sell. All right. Let me take 2 people from this classroom. For that also, I will take Manasi. Okay. And I will take one more person. Let us say I will take Deepika. Let us say Manasi has just bought the shares of Infosys by paying 100 rupees. Now Manasi is getting full tension. What will happen if the price falls down? If the price falls down, Manasi will make a loss. So what she will do is, she doesn't want to make a loss. She will go to Deepika and tell Deepika, I need a help. Can you please help me with an option where if the price falls below 90, I should be given a right that I can sell this share to you at 90 rupees. So Deepika will agree for an upfront premium. Manasi will pay to Deepika an upfront. The premium is always paid upfront premium. Deepika will write a letter where she will say, Manasi has a right to sell a share at what price now? At 90 rupees. Okay. Now, tomorrow there can be 2 outcomes. The price falls down to 50 rupees. And Manasi has a right to sell to Deepika at what price? 90. So Manasi will exercise the put option and she will receive how much money in her hands? 90 rupees. Suppose the price goes up to 120 rupees. She has a right to sell to Deepika at what price? 90. She will lapse the option and she will sell in the outside market for what price? 120. This option is what we call it as the put option. Can you write down till here in your books now? Alright friends, have you all put up till here in your books? Alright friends, now as I told you earlier, here also put option is nothing but it is a right to sell. Am I right? And there are two parties involved over here. One is a put buyer and the other one is a put writer. Okay, a put buyer in my case is who? Manasi. And a put writer in my case is who? Deepika. Alright, put buyer, what is the definition now? A person who buys the letter so that she can sell the share. Earlier it was buying a letter so that he can buy the share. Now it is buy a letter so that he can sell the share. And for Deepika, the definition will be a person who sells the letter so that Manasi can sell the share. Now here Manasi is the boss. Whatever Manasi will say, Deepika will only say, yes madam. Manasi says, I want to exercise. Deepika will say, yes madam. Manasi says, I want to lap. Deepika will say, yes madam. Whatever Manasi says, Deepika will only do that. Hence, it's always from whose point of view? Buyer's point of view. Can you write down this also in your books now? Alright friends, let's recall the definition the way we did earlier. Put buyer, a person who buys the letter so that she can sell the share. A person who buys the letter so that she can sell the share. A person who buys the letter so that she can sell the share. A person who buys the letter so that she can sell the share. A person who buys the letter so that she can sell the share. Now tell me, what is the definition of a put writer? A person who sells the letter so that Manasi can sell the share. A person who sells the letter so that Manasi can sell the share. A person who sells the letter so that Manasi can sell the share. A person who sells the letter so that Manasi can sell the share. A person who sells the letter so that Manasi can sell the share. I hope everybody is thoroughly clear with this. Now, I will just go to the next one and I'll give a concept heading called as payoff table for a call buyer. Okay. Friends, I'll give you a table format. The table format actually goes like this: S1, E1, action, status, GP, premium, NP. Okay. Now, Let us assume I have a right to buy at 100. So now we are talking from call buyer's point of view. Okay. I will give you 5 scenarios over here. Okay. Now I have a right to buy at 100. If the outside market price is, let us say, 80, will I exercise or lapse? I will lapse the option. Okay. I don't think I need 5 combinations. I think 3 are enough. Okay. I will lapse the option. If we lapse the option, it is called as out of the money. There are 3 terms: out of the money, in the money, at the money. All right. So my gross profit will be 0. Let us say I'm paying a premium of 5. So my net profit will become how much? Minus 5. Second case, let us say the outside market price is 130. I have a right to buy at 100. What will I do now? I will exercise the option. Exercising means it is called as in the money. My profit will be 3 minus 5, 25. Third case, let us say the spot price is 100. Exercise price is also turning out to be 100. In this case, you will either exercise or you will lapse. This is called as at the money. My GP will become 0. My premium will be minus 5. Net profit will be minus 5. Can you write down this in your books now? Once you're done, please let me know that you're done. All right, friends. This was from whose point of view? Call buyer's point of view. Friends, one of the features of the call buyer is that his loss is limited. If you see, the maximum loss that he can make over here is only once he lapses the option, that is minus 5. Okay. But this guy has got profit which can go unlimited. Okay, that is because here the price is 130. The price can go up to 200, 500,000. How much ever the price goes up, he goes on making profit. So it's called as a loss limited, whereas profit unlimited. Can you write down this also in your books? Ria, when your doubt is valid, if it's at the money, you can lapse it. Whether you lapse also, you get 0. You exercise also, you get 0. So whatever you do, you don't get any money in that. And whether you have to exercise or lapse, you have to click once. So do whatever you want to do. Nothing wrong. All right, friends. Have you all put up till here in your books? So now I will just go to the next part. I will do it here only so that I can save some time. So now we are doing about call buyer. Now we will talk about call writer. I'll put that with reading pen. Next one will be call writer. Friends, the table for call writer will be exactly the same as table for call buyer. These are the basic data. If the buyer lapse, writer will say yes sir. Buyer exercise, writer will say yes sir. No change over here. Buyer says out of the money, writer will say yes sir. All these also the same. Gross profit, instead of putting plus 30, it will become a loss. And premium, instead of being minus 5, this will turn out to be plus 5. I'll do that over here. This will be 5, 5, 5. So the net profit will be plus 5, minus 25, and plus 5. Now, as far as the writer is concerned, the loss will be unlimited, whereas the profit will be only limited. Because when the buyer makes unlimited profit, writer will make unlimited loss. Can you please put this also in your books now? Yes, I what you said is right. Premium is paid upfront. All right, friends. Have you all put up till here in your books now? Okay. Once you have put up till here, let us go to the next one. Payoff table. Now I'll put this with a blacking pen. Payoff table for a put buyer. Here the table format will be S1, E1, action, status, GP, premium, NP. I'll put the same numbers 80, 130, 100, right to sell at 100. I have a right to sell at 100. Outside market I can sell for 80. I will now exercise in the money and I will sell and make a profit of 20. Premium being minus 5, this will turn out to be how much? 15. Here I have a right to sell at 100. Outside market I can sell for 130. I will lapse out of the money 0, minus 5, minus 5. Here either exercise or lapse at the money 0, minus 5, minus 5. Friends, the features of a put buyer is that he will only make limited profit or he will make limited loss. That is because he makes profit when the actual price falls down. Here it fell down to 80, I made a profit. Price can maximum fall only to how much? 0. So his profit is limited to 100 rupees maximum. Hence we call it as limited profit, limited loss. Can you please put up till here in your books now? Alright friends, have you all put up till here in your books now? Fine. So let's go to the final one, that is put writer. You have understood by now what will be the difference coming in put writer. This part will change, okay, and this part will this will remain the same, doesn't matter. Okay, so here it will be minus 20 plus 5 plus 5 plus 5 minus 15 plus 5 plus 5, limited profit, limited loss. Can you write down this also and finish it off? Once you're done, let me know that you're done. Alright friends, so we are done with this and time is 9:30. So shall we pack up our first session now? Alright, now what we will do is we'll get back at 11 o'clock. 11 o'clock we'll continue solving the problems of options and mostly we'll finish off with options today and start off a little bit with interest rate derivatives, which I will pack up on Monday. Alright, so friends, see you at 11 o'clock then. Thank you so much. Have a nice time ahead. See you back at 11 o'clock. Thanks a lot, friends.